Well, hello and welcome everyone to another session in the Solid Finances series. This is our final session for this spring for the Solid Finances series. Couple of notes that might be maybe of specific interest. Our website, we do have recordings of all of our past sessions, and any handouts that were related to those sessions are posted on our website. So you can certainly utilize those as a resource while we won't be presenting any new sessions until the fall of 2022. My contact information is there as well. So if you think of another topic that you'd like to see us incorporate into next year's session, please feel free to drop it in the chat window, send me an email, somehow let me know what that are, and then when we're creating next year's schedule, maybe we can address that topic as well. Today's session was directly the result of a request from someone who had participated in Solid Finances as well. So we do appreciate those ideas for topics that you'd like to hear about. The sponsors for today's series, Montana State University Extension and North Dakota State University Extension, are jointly collaborating to bring this series to you at no cost. I already mentioned the website resources, but if you haven't been to the website, please bookmark that. A lot of great information there as well. One other housekeeping note, you'll notice there that I have two computers probably showing up with my name on them as possible presenters. They are doing some IT work on our wired internet connection today. So if we happen to lose our wired connection, I do have a laptop here on the wireless network. So if something happens and there's a little bit of a shuffle, it will be just a matter of switching from one computer to the next, and we will try to continue and finish up if that does happen. I'm not sure that it will, but we do have kind of a backup plan in place today. I would appreciate any questions or comments you have along the way. You're welcome to put them in the question and answer pod or the chat window. I won't read your name aloud, so those will be anonymous. We'll just say we've had a question come in, and then we'll try to address that as we go along today. So again, please do send your questions in. So today's topic, again, by request, life insurance, how much do I really need? This is a course I tend to teach every 2 or 3 years, and it tends to be pretty popular each time we do it. A lot of people seem to have this same question. So we're going to talk through some different ways that you can think about determining the correct amount of life insurance that you might need. At the end, we'll also talk very briefly about some of the different kinds of life insurance and how that might fit into your discussions as well. All right, so in the chat window, this will be your first chance to interact with us. Can you tell me who you think needs more life insurance? And I'm going to have A, B, or C, so you can just put in the letter if you want. But I've got somebody that's married. They've got 2 children, 2 young children. They're age 35. They have income of $50,000 per year. And they've got debt of $120,000. I have another person who's single, no kids, also age 35. Same income of $50,000 and debt of $120,000. That would be choice B. And then choice 3 is married, 3 adult children. This person's age 64, has an income of $100,000 and debt of only $5,000. So who do you think needs the most life insurance? All right, well, the consensus so far is that the person A needs the most life insurance. So I would agree, and we're going to talk a little bit how some ways we might calculate the differences between these folks and sort of support that answer that you all came up with. So the next kind of question here, or something to think about, what is life insurance for? And these are some, possibilities, right? Is it to turn your children into spoiled rich kids in the event you pass away? It's A option. Maybe you want to fund a nonprofit that's going to, save the world in your memory. Or maybe you want to make a really good plot for a movie of your life. I've got another colleague that used to always claim he never wanted to be worth more dead than alive to his family. So that was part of his life insurance calculation as well. So I present all of these to say there's a grain of truth in each of these, but my guess is these aren't the real reasons that people buy life insurance. Not that they don't happen, but more likely, let's talk about more traditional things that are probably going to affect most of us. The number one reason is probably to provide enough income to allow your family to maintain their current standard of living. So that doesn't mean that, you know, you're currently living on $50,000 a year, that when you pass away, you're going to try to provide $300,000 per year. That's probably not in your calculation. It's probably more if you're making 50,000 that you're trying to provide something similar for them to live on if you were to pass away. Maybe it's to pay for just your funeral expenses. Maybe you'd like to pay off your debts with that, or pay off some portion of your debts in the sense of maybe you want to be able to make the mortgage payment for the next 5 years. Maybe we're not paying off the house, but maybe we're taking care of, you know, the expected debt payments over some period of time. Paying for college education costs for children or grandchildren, you know, is another common reason. And we do see some people that want to utilize this as a way to contribute to a nonprofit organization that meant something to them. Much more likely, these are going to be your reasons than the reasons I showed on the previous slide. So let's talk a little more about calculating those. So first of all, after I've kind of read out some of those, what reasons are important to you for buying life insurance? And you can put those in the chat window and you can list one of them, several of them, you know, or something that I didn't even mention today. All right, they're starting to come in. An income replacement, burial costs, giving spouse some funds to transition, supplement the lost income from maybe a two-income family. Not to burden my children with end-of-life expenses. Yeah, those are very common items as well. Got one person indicating they participate in a small business and they would like to be able to pay off the business's debt as the business would transition and hope to carry on after that person's death. Excellent. Thank you for sharing those reasons. All seem very valid to me. So how much do we need? Well, if you want to do a quick internet search, you can certainly come up with a number of rule of thumb estimates, and some might be saying 10 times your salary, or 10 times your salary plus $100,000 for each child that you'd like to send to college. Others say, you know, take your debt plus your income, add up how many years you need to replace that income, add in some one-time expenses like college and funeral expenses, and then subtract out what you currently have saved. One way to look at it. Another, total debt plus 3 times your salary. And another, double your salary times your family size. So that would be $50,000 salary, double it, would be multiplying by 2, we get to 100,000. And then if there's 4 members of your family, you, your spouse, 2 kids, that would be how you would calculate it. So those are all neat rules of thumb, but my recommendation is we can do better than these rules of thumb in terms of estimating how much we actually need to purchase. So let's go through some of the things we can think about to help us do a little better than these very generic recommendations. All right, well, let's do kind of a step-by-step approach. And for those of you that were writing down the reasons you want to have life insurance, you can kind of skip maybe some of these steps if they're not something that's important to you. But for those of you that are going kind of down the list, we can continue with these and, you know, kind of add them up as we go. So one very common thing is to cover some type of funeral expenses, you know, whether that be a traditional burial or cremation or some other type of, you know, end of life care for your body, and then whatever memorial you might be considering. The average cost from the National Funeral Directors Association is about $8,000 for a burial with a very similar, with a casket, kind of a traditional. Obviously, some people do other traditions when people pass away, but that's a ballpark number. Some people certainly want to spend considerably more than that, whether it's on a, fancier gravestone, casket, elaborate service, lots of ways that could go up or down depending on your choices. One thing to think about too, some people do choose to prepay these expenses. So maybe purchasing a burial plot in advance, contracting with a funeral home, or purchasing a casket in advance. If you've done that, maybe that's something that doesn't need to be included in your life insurance expenses. So again, customizing it to your situation. But burial expenses, one item that we can certainly write on our list. Item 2 would be debt repayment. First thing I would recommend, and I recommend this in quite a lot of the different personal finance issues, is make a list of what you currently have outstanding. What debts do you owe? What are the payments? What are the interest rates? How many months are remaining on each of those types of debt? If there are co-borrowers, put information down like that to get a good list to start with. And also check to see if you have any credit term insurance on any of these debts. And for those of you that might not be familiar with that term, that's essentially a special insurance policy that would pay off the balance of that loan in the event that the borrower passed away. And it would be specific usually to one type of loan. So, your car loan, you may pay this extra few dollars each month. If you pass away before you pay it off, that special insurance policy would just pay for the cost of whatever remained on that loan. So check to see if that's in there, just so you're not double covering or double counting something as well. Not really common, but also not completely uncommon either, that credit term insurance might be available. And then 2, which of these are you interested in repaying? Just because you want to repay debts doesn't necessarily mean that you want to repay all of your debts. So, you can certainly make one list of everything and another list to say, I'd like to pay the mortgage off, I'd like to pay off the credit card, but maybe the car loans, they're fine, or maybe just the car loan on your car. Maybe you're thinking that your spouse would sell that car upon your passing, so maybe it's not important to pay off that car. So that step 2 would be to make a list of those debts and write down what their balances are. Another alternative or slightly nuanced approach to the debt repayment, you can certainly say, we owe $190,000 on our home and we have $60,000 of other debt, so $250,000 total, and that's the amount. We can also think about, maybe you just want to cover the payments on those debts for some number of years. So, maybe you want to give your survivors 5 years of debt payments as a time for them to transition and maybe come up with a way to replace your income or cover those expenses. So in this case, the quick example that I've got here is we do have a mortgage with $120,000 balance. If the goal was to pay it all off, we'd want to put the whole $120,000 on our list. If the goal was maybe just to cover 5 years of payments to give your family some time to transition, I made the numbers very simple, but I have monthly payments of $1,000 each, with a total amount then for 5 years would be $60,000. So in that case, the amount of life insurance we might be wanting to purchase to cover this particular part of it would be $60,000 and not the full balance of $100,000. So that can be another way, to consider what the correct amount of life insurance is. Another reason you might want to consider maybe that lesser amount is maybe you calculate all of this up and you determine how much you want, but maybe you can't quite budget for it all now. So maybe, this is kind of a, maybe you're dreaming that you would have $300,000 of life insurance, but maybe you can only afford $220,000 of life insurance. This might be a way to kind of bridge the gap a little bit and think about what coverage you are providing to your family if you're not being able to provide everything you had hoped for. All right, income replacement. This one, I would say, is maybe the hardest to calculate. Um, and there's a couple different reasons why, and you can certainly spend some time examining your current income streams and kind of refine this. So first, let's talk about the general concept, and then we'll talk a little bit about some of the ways you might want to improve or enhance the details within this. So understanding your current annual income that you're earning. And again, when I talk about your income, many of us live in a household that has more than one income. With life insurance, we typically want to think about what if one person passed away. Life insurance policies are typically on one person's life. So maybe it's the wife, maybe it's the husband, but it's not jointly as a couple typically. So we do want to look at those income sources as separate items. And there may be some joint income. Say, for example, a couple owns a rental property. If one of the members of that couple passed away, that probably wouldn't change the rental income piece. So some pieces of that income maybe don't need to be accounted for, but other pieces of the income, maybe from a person's working earnings would, or maybe from Social Security or a pension that's paid directly to that individual that would stop upon their death. And for any of you with pension plans, you may want to check to see what payout option you've selected or what you're currently receiving. Sometimes if the retiree passes away, their spouse is entitled to some continuing benefits after their death. So just understanding what the actual income loss would be if that person passed away is important. So when estimating your income, getting that total is helpful, but also then looking at what income sources would go away when a person passed away is really the list that we're trying to get to. So that's kind of step one, is understanding your current income. And then, step two is how many years are you planning to need this income replacement? And we might think of this as very directly related to age. So, as somebody who's 40 years old might be planning to work till they're 65. So there's 25 more years of income that their family may have been expecting to receive from them. So planning on replacing all of those years, or at least some of those years, is probably important. But if it's someone who's 60 years old, maybe they're only planning to work for 5 more years. Maybe somebody's 70 years old and they're already retired. So in terms of maybe their current earning potential, there isn't income to replace in that sense. There may be some differences in terms of pension or Social Security benefits, but understanding what income sources would go away or be reduced if someone passed away is what we're really trying to get at here. So take a close look at where your income sources are, and then also just the nuance of what would happen if that person were to pass away to the income for the family going forward. Now, just because somebody, let's just say that you make $50,000, you're not going to take all $50,000 of that home, right? So if you've ever looked at your pay stub, you notice there's a big number at the top and a smaller number that actually goes to your bank account. And some of that is for things like payroll taxes or maybe health insurance that come off. If specifically, let's just say it's health insurance for that actual employee who's earning that paycheck, if they pass away, you're not going to be purchasing health insurance for them anymore. So we don't necessarily need to replace that specific income if it's just for that person. Same for some of the payroll taxes. If you were to pass away, you don't pay Social Security taxes. Once you've passed away, your family's not looking to replace the tax amount they were paying. They're looking to replace the number at the bottom of that paycheck. So adjusting your income estimates for those items is also helpful. And then staying with the reduced expenses, if you're in a household that has, 3 phones and one person passes away, you may only need 2 cell phones. So some of your expenses will be reduced as well. Same with food, clothing, health insurance for that particular individual, things you'll just no longer be purchasing if you're in a smaller household. Now, other bills, let's say maybe your uh, satellite TV. It's the same whether two people watch that TV or three people, right? Not a change in that particular expense. So looking at your expenses and seeing which ones will change can be helpful. But maybe there's also increased expenses, maybe because you went from, let's say, a two-parent household to a one-parent household, maybe you'll be spending more on childcare, where maybe in the past you could, trade off so that, you could, your children could have someone to watch them while maybe you had to work an evening or something. Maybe now that's an additional expense. So taking a look at that as well. Maybe lawn care too. I know at my house, I'm the primary lawn care person. If I passed away, I'm not sure my wife would be interested in that, and she may choose to hire out that. So that would be an increased expense. So taking a look at your budget and looking at some of those different things that people are providing can certainly be helpful. So, and then examining your budget for other reduced expenses, and that might be, we did talk a little bit earlier about credit term insurance for a particular loan that you might have out. So maybe you've already got some insurance that will pay off one of those debts. So again, don't double count it. That's kind of the key point there as well. So if you already have credit term insurance on your mortgage, don't also count for it in your life insurance. So. And then also take a look at what income sources might kick in if you were to pass away, right? So we talked about obviously your W-2 income, earnings from your job will go away if the person passes away, but maybe you have some other benefits that will start. One example is just Social Security. It does have survivor benefits. Generally, and I'm going to very generalize, children up to the age of 18 are eligible for some benefits from Social Security if their parent passes away. And often there are some widower benefits as well, generally for those over age 60, but you can certainly read about survivors benefits on the Social Security website. So don't forget to account for new income sources that would happen when you're estimating how much you might need. So kind of the simple estimate with some of these things, again, estimating that current salary. And again, if you'd like to get a little more detailed, I would definitely recommend you subtract out things like Social Security taxes, kind of work from the bottom number on your paycheck as opposed to the top number. And then taking a look at whatever those reduced expenses might be. Like we mentioned, maybe you're having one less cell phone in your family, or maybe you're going from a 3-car family to a 2-car family. So there may be some savings associated with some of those things. Other income sources, are things like Social Security going to kick in? Will you receive some additional income from something else? So then you can come up with that goal of what you're going to replace. So this is how much income you'd like to replace in a single year. And then how many years that you want to replace that income for, right? Maybe it's 10 years. Maybe that's until your youngest child is age 18. Maybe it's until your spouse reaches age 65. Maybe it's until you would have reached 65 and chosen to retire. So those are the places you can kind of refine this estimate. One thing here, I didn't adjust for inflation. And there's just a couple things I'm going to mention about inflation. One, if this money were to come to the survivor as a lump sum, they could invest it even in some relatively safe investment choices and earn an amount equal to inflation. So in that sense, we don't necessarily need to account for inflation as far as if you think about them receiving a lump sum today and having money to pay for things over the next 10 years, because they can invest it, they can kind of cover the inflation aspect of it with their investments going forward. The other side of that, though, is let's say you purchase life insurance now and you live for 10 more years before you pass away. it is a good idea to review your life insurance needs periodically. And inflation is one of the things that might change over, say, 5 years from now. Maybe your salary has gone up in 5 years, and you may need to do some adjustments that way. So moving on to another step in the process here would be estimating educational expenses. Are there family members that you would like to support their education? And maybe that's somewhere in the K-12 range, and it's a private school that you're paying tuition to. Maybe it's some type of higher education, whether that's a trade school, a public university, or a private university, or a community college. And also, do you know anything about what the cost might be for that potential education? Maybe it's 2 years of community college that's relatively low cost. Maybe it's 4 years at a private school that's quite expensive. So again, knowing a little bit about where they might be interested in going, and also maybe their potential for scholarships or loans along the way, and then come up with an estimate of what that amount is that you'd like to set aside towards that particular family member's education. Another item here I'm going to say is special needs. Each of you are going to be able to know a lot more about your specific situation than I could, especially not knowing you specifically. But maybe there's a family business you're involved in. Here in Montana, we certainly see both small businesses and ag operations, where if a key owner or key member of that business passed away, it would really change the dynamic of the business. I had an uncle that was in business with his two brothers, and they made a choice to cover enough life insurance, each of them individually, that if they passed away, it would be able to pay off all of the business's debt, which would give the surviving brothers an opportunity to allow the business to continue while they sort of figured out how it would work going forward, minus one of the key partners. And it did actually happen that my uncle did pass away in an auto accident, and it did give them the flexibility to allow that business to proceed, at least in the interim term, while they came up with a new plan with one of the key players missing. So, but many of you, or some of you, may also have a family member that needs something special. So maybe they're a developmentally disabled child. Maybe you've got an elderly family member that you're caring for. Maybe you have a family member that needs some type of special care that you'd like to provide for. And maybe life insurance can be part of the way that you provide funding for that. Some of you may have even seen there was a famous case a while ago where somebody left a big pile of money for their pets care. So that there are certainly some options too if you had something, I'm going to call that unusual, but provided a lump sum to make sure that your pets were cared for the rest of their lives as well. Many people do, through their will or through a life insurance policy, provide, a charity some funding as well. So, maybe you had a particular connection with a charity, or maybe that charity even provided services to you, in your lifetime, and you wanted to sort of pay them back. So this is certainly an opportunity there. One thing with life insurance too, you can have a beneficiary of that life insurance policy that is individuals specifically. So maybe it's your spouse, maybe you're writing on there equally among my children, maybe you're writing on there, ABC nonprofit at this address. So you can certainly designate that. If you also have a will, please note that the beneficiary form for your life insurance will take precedence over your will. So if in your life insurance policy you say, my son Bob gets this, and then in your write a will it says, my son Bob and my daughter Sally split it equally, the beneficiary form on the life insurance is going to take precedence over what's in the will. So make sure that the two are working together. It will help improve or diminish family conflict going forward, and also make sure you're directing it to the right person. There are some times that if you are working with an attorney to create a will that maybe is a little more complex, that someone might actually create a trust and have the beneficiary of the life insurance policy be the trust, and then the trust can distribute funds, to the intended individuals or organizations at the times correctly there. So just be sure you check with an attorney if you're doing something, I would say, maybe a little bit more complex than just say giving it to your spouse or your kids, and maybe also your accountant to get some advice if there's some pros and cons in terms of taxation or kind of benefits like that that might be advantageous one way or the other in terms of how you deliver the funds to that individual. All right, so we've got a question coming in. And that question is, can my insurance agent help me set up a trust? That's a good question. It probably varies by insurance company, but in general, I wouldn't necessarily say that insurance agents are always set up to be trustees. It's possible, how you manage your trust and who you have hold assets and choose to be the trustees is certainly something you can think about. My guess is you should probably have a visit with your attorney and your accountant in terms of maybe selecting and identifying the best place to house those funds and kind of create the structure around it. It's possible that your insurance company might be able to provide those services, but just because they're selling life insurance, I wouldn't say they're also set up to be a trust management company. So excellent question. All right. So once we've kind of went through these things, adding up, those different expenses that we've went through, the ones that are important to you, we can add it all up and we can get to a total of the insurance number that we need to have today. And then before we go out and purchase it, though, it is a good idea. Do you have other current life insurance policies? Many employers, especially larger employers, provide some. Oftentimes, it's a modest amount of life insurance, 10 or 20,000, for every employee that's employed. So if you're getting that amount, subtract off that amount as well. Same for some membership organizations. I'm thinking here of like a teachers union. They may also have some basic amount for all members that's coverage as well. And again, if you've purchased any of that credit insurance on the specific loan, subtract those items out. And then also, are there assets that you can sell because you passed away that are available to your survivors? Maybe that can help offset the amount. So, maybe there's a second car, or maybe there's a boat that only you were using or that they would choose not to use if you weren't around, that could be sold and freed up for them to do other things. And then are there other financial assets available? And one of the things I'm thinking about here is like a 401k plan. An employee may put money into a 401k, a 403b, IRA, those type of accounts. Well, obviously, if they pass away now, those funds are not going to be needed for their retirement expenses. So those funds are now available to the survivors, assuming the beneficiary forms indicate that they'll be receiving them. Those can also be something that you may want to reduce your life insurance purchase by. That would also be true. I talked a little bit about the retirement accounts. Defined benefit accounts, which is a different type of retirement account, which pay you a basically set amount per month over the rest of your lifetime. Oftentimes when you retire, you make a choice that says, I'll take the higher dollar amount. When I die, all of the payments stop. You can take a slightly lower amount, and oftentimes then the payments say when the employee passes away, the spouse receives 50% of the benefit that the employee was receiving, or 75%. There's some different choices that you can make. So understanding what your other financial assets are that are now available to fund your survivors' living expenses can also help you kind of fine tune that life insurance amount. The next thing to think about is, we can go through this calculation today. You can go through it, figure out what you need, get the right number. But even if we look at this a year down the road, your needs are going to change. Your family, maybe you have new members, maybe you got married, maybe a new child was born. Maybe your children have grown, left home, are independent now. So you're not worried about maybe covering their education expenses or their day-to-day living expenses. Also, just as time goes by, likely the number of years of income you're replacing is going to go down as well. So, a 30-year-old may plan to work for 35 more years. It's probably unlikely that a 60-year-old is going to work for 35 more years. So our needs are going to change over time, and it could go up if we think about something like a new family or a new family member being added. But they may also go down as your children finish schooling or you get closer to retirement. We've got less years to account for. And then, over time, many families are also paying down debt and increasing their savings. So maybe as you buy your house when you're 30, maybe it's paid off when you're 55. Your 401k balance or just general savings when you're 30, are probably a lot smaller than when you're 60. So all of these things are going to kind of continually be changing. So you need to review this over time. Now, I also understand that not everybody wants to review their insurance every 6 months. So a couple general rules, and then we'll talk about maybe one way that we can help manage that as well. So generally, life insurance needs, it's generally pretty low for single people. They're not trying to cover spouses. There are fewer spouses for single people usually. Or single, not spouses isn't the right word. There should be no spouses if you're single. Family members that you're supporting is generally less when you have a single individual. Obviously, there's oftentimes no kids. So you may not be providing for their living expenses or college education type things. So they tend to be highest life insurances for younger couples or younger people that have kids. So you have more working years to replace the income for, and more people that you're supporting, and more things like education. Also, younger people may have higher mortgage burdens than somebody that's older. But generally, this is going to decline as you get older. So you're going to pay down your mortgage, your kids are going to grow up and move on. Your number of years remaining to work are going to decline as well. So it generally starts low, kind of peaks maybe when we have younger families, and then you're going to gradually decline as we near the end of our working years. So recognizing that, having a flat amount of life insurance over the course of your adult life probably doesn't match your need very well. So let's talk about the types of life insurance that you can buy. And how a couple of these might kind of work together. So the first one, which is the most common, is what we call a term life policy. Term life says that you are provided X dollars of coverage for some term, 10 years or 20 years. And then we have what we call permanent life insurance policies, and there's a couple different ones here. The simplest one to think about is whole life insurance. You agree to pay a flat amount every month for the rest of your life. And when you pass away, your survivors will receive a payment. And then we got universal and variable life insurance, which are kind of like whole life, but they have kind of a built-in investment portion as well. So let's talk about how we can utilize these a little bit to match up with your needs. So the first one, term life insurance, which I would certainly say is the most common, also the simplest to understand. Purchased usually in 10, 20, or 30-year increments, which means I walk in today, I say I would like life insurance for the next 20 years for $100,000, and they would give me a price per month that I would pay over the next 20 years to have that coverage available to me. It's usually pretty low priced for younger people. And why is that? Well, younger people tend not to die. So if you're 25 years old and you buy a 10-year policy, the statistical number of people that die before they turn 35 is pretty low. The insurance companies are well aware of those statistics, and they price it relatively cheaply. It is more expensive for older people. So if I'm 65 years old and I walk into an insurance office and say I need 10 years of coverage, well, statistically, the odds of me passing away in the next 10 years are much higher than that 30-year-old that had just walked in previously. So the cost of purchasing that is going to be much more expensive for that older individual. The reason also that these policies are typically much less expensive than a whole life policy is there is a good chance the insurance company is not going to pay out a death benefit. So that 30-year-old that buys that 20-year policy, if they live to 50, the policy expires. They don't receive a benefit. The insurance company didn't have to make a payment. They had the coverage in the event they passed away. But if they did not pass away, no payment was made. So the insurance company, with their actuaries, they calculate those things, and it makes those policies more cheaper than a whole life policy, which will make a payment at some point. Laddering policies is a common strategy for matching up policy purchases with that sort of general idea that most of our life insurance needs decline as time goes on. So the way that would work is a 35-year-old will go to the insurance agent today and they say, you know, I need $300,000 of coverage. But down the road, I'm going to need less coverage. So that insurance agent might say, well, let's do a $100,000 policy for 30 years, which means that if that individual passes away anytime in the next 30 years, they'll get a benefit of $100,000, or their survivors will. They're also going to sell them a separate $100,000 policy for a 20-year term, and a third policy also for $100,000 for a 10-year term. So that means for the first 10 years until this person turns age 45, they're going to have $300,000 of coverage. And if they just continue to make the payments on the policies they purchased 10 years ago, when this person is age 45 to age 55, they're going to have $200,000 of coverage because that 10-year policy will have expired. The other two policies will still be in force. When that individual turns age 55, their coverage is going to drop to $100,000 because the second policy is expired. At age 65, all of this person's life insurance coverage will have expired. So if they lived age 65, the survivors won't receive any benefits. And this person was able to do that with one purchase that was made when they were age 35. So this is a really common way to kind of set up in advance or estimate what your decline in life insurance needs might be. So a common tool that allows people to get more coverage up front, less later down the road, but make that purchase when they're relatively young and get probably a pretty reasonable price for purchasing that. Now, whole life insurance works a little bit differently. When you purchase whole life, you agree to pay a fixed premium every year or every month for the duration of the policy, which is typically your lifetime. And then because it's for your whole lifetime, there is a guaranteed death benefit. So at some point in the future, you will die, and they will make a payment to some beneficiary. Limited flexibility to make changes to these policies down the road. Typically, the premiums are higher for younger buyers than compared to term life insurance, but they do say flat for the whole person's life. So if you purchase that policy when you're 20, pay a flat rate. By the time you're 70, those rates are probably going to seem very cheap, but they might seem quite expensive when you're age 20. So because these policies are promising that they will make a payment out, some insurance companies allow you to borrow while you're still alive against the benefits that would go to your survivors. So that can be a perk of this type of policy, is you can borrow against that potential benefit down the road. Universal life, somewhat similar to whole life. The premiums are kind of split in two portions. One portion provides life insurance, another portion of that is invested. You may get some choices in terms of how you invest those funds, which might change your death benefit for your survivors as well. So it's sort of a combination of an insurance product and a savings vehicle. So that works for some people as well. Variable life insurance, there's a guaranteed minimum death benefit when you have this type of policy. And this type of policy, you get to select some investments, and if your investments do well, it increases the cash value of your policy, which might increase the benefit down the road for the beneficiaries of this policy. So a little bit different way to think about life insurance, but might fit for you as well. So those are kind of the main types of life insurance. So with that, are there questions? Okay, we do have a question that's come in. Can my rates change because death rates change over time? I'm specifically thinking about the coronavirus increased death rates. Did that cause insurance premiums to go up? So first of all, when you're purchasing a life insurance policy, many of them do when you purchase it, you have a fixed dollar amount that you're going to pay for the period of that life insurance policy. So a 10-year policy, oftentimes it will be quoted that you're going to pay, $112 per 6-month period or whatever that might be. And that would be fixed over the course of that. Sometimes policies, especially term policies, will need to renew. So 10 years goes by, you want to purchase 10 more years. And certainly the insurance company is constantly updating the new pricing of policies. So if death rates increased for some reason, whether it be something like coronavirus or maybe just, cancer or heart rate deaths really skyrocket, they would certainly incorporate that into their pricing as well. But once you've purchased it, typically those premiums are fixed for the life of that policy. Now, I know here at MSU, we can do some purchasing of policies. And they're kind of 1-year policies that you sort of renew every year. And those do change based on both the age of the person buying it, i.e. the employee, but they're also updating for any changes in actuarial tables that might be going on as well. I guess a follow-up question, how much have insurance rates increased due to the additional deaths caused by coronavirus? I have not seen any specific rate increases. I also will have to say I have not looked, but I'm sure that those additional deaths are factored into actuarial tables. Kind of the way an insurance company, makes these work is they need to have a good statistical estimate of how likely someone is to pass away each year. And that's what they base their rates on, so that there's enough sort of collective money in the pool to make those payments while providing them, I guess, a margin as well. So they're certainly well aware of those things, but I have not seen any specific data about changes the last year or two. So the next question is, what should you do if your universal life company said they would pay based on the market and it doesn't? It just says the minimum even when the market is high. Yeah, so one of the things about, any life insurance policy, it's a contractual agreement. So you really need to look at what that policy said when you purchased it, and then, look at what the triggers are that would cause it to increase or decrease. And, when we say market, there might be a specific set of investments. Maybe it's specific investments you chose. Maybe they've got it on the S&P 500. Maybe it has to go, maybe it's a fixed rate if the market is between 0 and 10% per year, and maybe it goes up only if the market does better than 10% per year. So you'd really need to look carefully at the language in your contract, and that's going to determine what the benefit is. If you think that they're not following the contract, at least here in Montana, we do have a security commissioner of insurance. And you could certainly reach out to them and see if there is sort of a breach of contract type situation that would need to be looked into. Other questions? All right. Well, seeing no additional questions, thank you all for joining us for this session of Solid Finances and for this season of Solid Finances. Like I said, this will be the final session for the 2021-22 Solid Finances year. We do expect to return in the fall of 22. Please watch our website, and we will likely be posting things in probably early September about the next season and what the schedule will look like there. We will also, for those of you that have signed up for the reminder email, we will send at least one invitation to you next year to give you that new schedule and give you an opportunity to sign up for next year's series. But we'll only send 1 or 2 reminders that way because we don't want to be a spam email service. So you'll get 1 or 2 reminders. Please watch for those in the early fall. And hope everyone has a great summer, and the resources and recordings are available to you on our website until we start with new sessions. Have a great day, everyone.